Sure.
Eternal, the top Nifty loser in an otherwise strong market after FTSE and MSCI reduced their weight on the stock. IIFL Capital estimates an outflow of nearly $380 million on the back of FTSE weight reduction on May 27th and nearly $460 million due to the MSCI on May 30th, causing supply worries.
GE Vernova, that's trading higher with a gain of close to around 10% after posting an operational beat in Q4. The margins come in at around 21.9%. That's the highest among the high voltage transformer peers, and the order inflow as well is much stronger than expected.
Balkrishna Industries falls about 10% after its fourth quarter net profit declines by about 25% due to unrealized forex losses. The EBITDA too falls about 10%. Margin contracts to 22% year on year.
Transrail Lighting gains in early trade on the back of good Q4 numbers. It's marked by strong financials and a 44% growth in its order book on a year-on-year basis.
More stocks remain in focus on the back of their fourth quarter earnings. We have a bunch of them moving in different directions. On the one hand, we have Kolte Patil and JNFC trading higher post good earnings, while Dreamfolk sees a dip in their margins and a 19% fall in their EBITDA. That stock down by 7%.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and we've started off the week on a positive note. As you can see, the top key indices that are up for you on the screen, both of them are positive. However, we have come off a little bit, Mangalam, from the highs of the day.
Yes, Nigel, there was supposed to be supply around the 25,050 to 25,100 mark. Let's see whether the market sustains above that or not for an extended up move in the May series expiry week. But no problems for the broader markets. The portfolios would be looking very good. And the Nifty Bank also off highs, but still sitting with a gain of almost 100 points. In this market, let's get you some ideas for profit. Coming in from our colleagues at Money Control Pro, we have Kanchi Shah joining in with the stock. Kanchi.
So today let's talk about Eicher Motors. The company is best known as the manufacturer of Royal Enfield. Let me briefly touch upon its Q4 performance. Royal Enfield's revenue grew by 23% on a YOY basis, which was driven by a volume growth of 23%. Despite the higher sales, the EBITDA margin contracted by 252 basis points due to increase in marketing expenditure and elevated commodity prices. In FY25, Royal Enfield crossed a significant milestone. For the first time, it recorded over 1 million annual sales unit. It currently holds an impressive 88% market share in the domestic middleweight motorcycle segment, which clearly reflects the brand's dominance and customer loyalty. One of the key growth drivers has been the shift in the consumer preferences towards premium bikes. Royal Enfield has successfully capitalized on this trend through a refined product portfolio and a stronger brand positioning. Importantly, we are also seeing a demographic shift with the average age of customers decreasing, indicating a rising interest from younger buyers. On the international front, the company is making strategic moves. It recently inaugurated its first fully owned CKD assembly plant in Thailand. This marks a significant step towards its increase in international footprint. Meanwhile, the commercial vehicle business under the VE Commercial Vehicle, which is a joint venture of Volvo and Eicher Motors, has outperformed industry trends. In a year where the sector grew just by 0.3%, VECV has reported a 5.4% growth. With the projected 15% upside based on the SOTP valuation, Eicher Motors is a compelling stock to accumulate on a longer-term basis.
All right, Kanchi, thanks a lot for that. Let's focus on the primary markets now. We had two IPOs opening today, Aegis Vopak, and the other one is Schloss Bangalore, which owns the Leela Palaces Hotels and Resorts. Here's Dalal Street with a 3,500 crore rupee IPO, of which 2,500 crore is fresh. We are now joined by Ankur Gupta, the Managing Director, Partner and Head of Real Estate for Asia Pacific and Middle East at Brookfield, the owners of Schloss Bangalore. Thanks a lot, Ankur, for joining in. Always a pleasure speaking with you. The fact that you're raising about 2,500 crore for fresh issue implies that there will be a lot of debt repayment. So, let's get a couple of things out of the way first. One, what would be the interest cost savings? What would be the residual debt on your books? I suppose there was close to 4,000 crores on your books before you, decided to raise these funds. And the second part, when you look at revenue growth, you have about 13 properties right now. How many of them come on stream, and how do you break revenue growth into, increased number of rooms, increased occupancy, and increased RevPAR?
Thank you very much for having me over, and good morning to everybody from a very rainy Bombay today. So firstly, the primary proceeds of the IPO, about 2,500 crores, which is the primary issuance. A majority of that capital will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post-IPO, the net debt position of the company, gross debt minus cash, will be close to zero. which means for a company that did 700 crores of EBITDA, cash EBITDA over the last 12 months, and the prospects are even stronger getting into FY26. This company will have a lot of liquidity.
Right.
So the average interest cost was slightly north of 9%, and reducing the debt by 2,300 crores will reduce corresponding interest burden for this fiscal or balance of this fiscal. But most importantly, it primes the company very well for growth using a combination of almost no leverage,
Right.
cash on the balance sheet, as well as strong internal accruals into the future.
So 150 to 180 crore average annual interest cost savings is
Slightly more than that. Slightly more than that.
about 210.
That's correct.
Okay, all right. Good to have you in the studio, Ankur. Thanks a lot for coming down and welcome to the stock markets. I think it's a great time, going by the kind of demand you're seeing with regard for hotels and, the entire leisure space. But a couple of details. As you said, your margins have been very, very strong. Now you'll be debt-free and you'll be throwing up a lot of cash as well.
That's correct.
How sustainable are these margins? Because I'm looking at your peer set from the listed space and you're head over heels among everyone. You're around 49% or thereabouts. Is it sustainable?
So let me break down the margin into a few different components for you and for your viewers. Firstly, the focus of the business is on luxury.
Yeah.
Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin. Second part, in how do you sustain higher rentals? Yeah. I think the second part of the equation is very, very important, which is how you sell, who you sell to, and how do you service them. Our net promoter score is industry leading. So not only do we have highest rents, we have highest margins, but that's on the back of very strong customer affinity for the product. Not just the real estate, the built environment, but also the offering that the Leela Palaces offer. 800 plus touch points for every customer that begins its journey at a Leela Palace. And getting 85 out of 100 in that is almost is work of real labor. I think that is very important, and that is the singular focus of this business, which is luxury, service-oriented, high-quality properties, which constitute the Leela Palaces and resorts.
So it's sustainable at around this 49%.
I would like to believe.
You would like to believe it. Let's come back to the growth part, because while it is luxurious, you have still 13 hotels only. You do have a pipeline, right? Plus a near 35-40% premium over the industry when it comes to revenue per available room. Going forward, what is the kind of growth that you're targeting? Because the industry is likely to grow at around 10 to 11%. You will have the kicker of increased occupancy in your existing properties, increasing RevPARs, and newer properties coming on stream as well. So will you grow at 2x the industry? So
just to put some things in context, when the US GDP grew from similar levels like India, some slightly north of $3 trillion into 7x. So when the GDP grew 2 times over a course of a short period, this was in the 70s and 80s, and same as the data for the European Union as well. Chains like Marriott, Accor, etc., grew at 4 to 7 times, which means the hospitality segment gets a disproportionate share of underlying GDP growth. That's because business activity picks up, per capita GDP goes up, affluence levels goes up, etc., etc. So we are very confident that the luxury industry has very strong demand characteristic. At the same time, supply is very limited. India is just home to 30,000 odd luxury hotel keys. Leela's market share is more than 10% of that. I would like to believe that under the Brookfield ownership, we've grown from 8 hotels to 13.
Yes.
We've increased the margin between us and the comp set 2x. So we are commanding 20% premium. We are now at 40% premium. I think the way that the business has been established is being built for perpetuity, which means that this growth should sustain. The management team is professionally run. Our board is composed of very eminent personalities. So through a combination of focus on luxury segment, good access to capital, and an amazing brand that's been there for 40 years. Yeah. And I would also like to believe that the India story on luxury hospitality is now very well recognized in the world. We have a mass movement of domestic customers aided by return of foreign travelers. It's creating a perfect storm in many ways, which Indian hospitality has not seen for many decades.
Okay, all right. Quick couple of questions then. A couple of your properties are still, struggling, like the Chennai property, I think so. It's yet to break even, if I got that correct. Could you tell us what's the outlook there? What's the turnaround strategy for a couple of these projects? And also, are you planning on re-entering other geographies like, say, Goa?
Yeah. So let me answer your first question. Chennai property commands an amazing positioning in Chennai. It's a beautiful property on the marina in Chennai, and it commands probably one of the highest ADRs in the city.
Okay.
And at good, healthy EBITDA margins.
Oh.
So Chennai property is doing well. In fact, since 2019, the EBITDA has grown substantially at the Chennai property itself. But not to single out on one property itself. The growth pipeline, as you see, yes, Goa is on our radar, but we've also expanded a lot into places like in Mumbai, like in the hills. We have a hotel coming up in Srinagar. We have a hotel coming up in Sikkim. We've entered the spirituals to tourism sector. We all saw what happened.
To the specific question, there are still losses at Chanakya in Chennai, right?
I would say, those losses are on a net basis. On an EBITDA basis, these properties are contributing very, very well to the business.
When do they start turning around on a net basis?
As I said, our net debt on a consolidated basis.
So once you become debt-free, these will become net profit as well. And final question, business travel. That is what proportion of your sales? That's structurally down post-COVID, right? So how has that mix changed?
I would say that business travel has structurally changed. I would not say it's down.
Got it.
Business travels have become more, I would say, unified with personal travel. People are using the shoulder days a lot more. So the Thursdays, Fridays, and Mondays.
Got it.
Leela business on the back of 250 people who constitute our sales team is very, very hard to replicate. I'm not sure that any luxury brand exists beyond hospitality sector with such a large dedicated sales force. So I would say that the true value of the business lies in talking to our customer, both in terms of outreach as well as service.
All right, Ankur, we appreciate you coming down and detailing all of that for us. We wish you all the best with regard to the IPO. And on listing, we re-invite you to join us on the show. We'll squeeze you a little bit more for some numbers. Thanks a lot.
Thank you very much
for joining in. Well, time to slip into a short break. On the other side, we'll be joined by the management of Glenmark. Stay with us. Welcome back. You're tuned into Chartbusters here on CNBC-TV18. The next management then that we have is Glenmark Pharma. They've reported a steady set of numbers. The problem was that in the past quarter, they couldn't achieve the guidance that it set out for the year. However, what's the way ahead? Well, we're joined by Mr. V.S. Mani, the ED and Global CEO at Glenmark Pharma. Hi, Mr. Mani. Good morning. Thanks a lot for joining in. Well, you're guiding for around 10 to 12% growth on the top line. Sure. Could you tell us what's the breakup? How much are you factoring in terms of a growth with regard to the United States? Because plenty of uncertainty out there. And what about the Indian operations? What is the growth number you're factoring in? And also on margins, last year you fell short. This year you're sure you can achieve the margins you've guided?
Sure. So thanks for the question. Let me set some context. So in the current year also, we had a turnover of about 13,300 odd crores with a growth of about 12%. And obviously the margins were for this quarter looks a little lower. For the full year is about a little more, about 17.7%. So obviously the margins were a bit lower on the back of mainly the US business. We did not get any key big launches. So obviously those had a play in that. Now going forward, obviously the next year we have spoken about a business growth of about 10 to 12%. But giving it a business-wise breakup, we would probably keep it to a later date. We're planning to have an investor day. So at that point of time, we'll do that. And we have guided to about a 19% margin next year. And obviously, that will be more on the back of improved performance in the US, as well as some growth in royalties, as well as some efficiency. So all put together, we should see closer to 19% that we guided.
All right, so 19% margin, you're comfortable with 10 to 12% growth in India is what you've said. Overall revenue...
I said the overall business growth is about 10 to 12%. I have not broken it up business-wise. India or the US are
okay, not quantitatively, but if you could qualitatively tell us what would grow faster? I mean, do you think US would be the one driving this growth, or would it be India? Because there are uncertainties everywhere, right?
I appreciate. So let's look at the current year for some, way forward. So the Europe continues to do well, and it did about 17-18%. So we see that doing pretty well. India would be pretty steady. Obviously in IQVIA, etc., have been growing at about 10% or so. And then again, if you look at the emerging markets, while we had some currency losses, etc., otherwise the growth has been in excess of about 10%. So I think in the US, obviously, we are, looking at some approvals in terms of the respiratory ones that we are expecting in the quarter to end or and also the second half. These are all more in terms of the fluent. So if these all come together, then obviously we see achieving the growth of 10 to 12%.
And you expect margins to improve in the US despite the uncertainties that we're seeing around tariff and pricing, right?
We are looking at these critical launches. So these happen, then obviously then your margins would definitely improve. Yeah. But besides that, also the rest of the businesses seem to be having a decent margin. So I think all in all, with this royalties, some bit of improvement in the US as well as some efficiency all put together, we should be close to what we are projecting.
All right. Royalties, I think you're guiding for around $100 million, right, in this year?
Yes.
And what is the glide path? Because in the past, you'll have mentioned that in the next few years, you expect it to move to around $200 million. Yeah. By when?
Yes. So just to give some color, royalties, which was 40 million last year, touched about 80 million in the current year, and we're expecting to touch 100. We already have commercialized it in 45 geographies, and obviously we're looking at 10 to 12 more geographies. It's doing well in all the markets where we are present with our own footprints, as well as in partnered markets like Menarini with Europe, as well as with South Korea, etc. We are doing quite well. So I think going forward, we expect in next 3 to 4 years to at least close on to the 200 million. Yeah.
All right. Next 3 to 4 years, $200 million out there. What is the update on both Monroe and Pithampur plants? You have indicated that there could be an inspection anytime soon. Is it possible for you to give us a timeline? Maybe by, say, the next couple of quarters, you expect some sort of resolution, if you could give us a sense?
It'll be difficult to give a timeline and resolution, but I can say that Monroe, obviously, we have done enough work and we expect the agency to come sometime. As well as the Pithampur goes, we are working with the agency to resolve the issues. And there are no major launches out of there. The critical launches in the current year and couple of years are from Aurangabad, which, as you know, got inspected a couple of months ago and it had a 0483s. So I think all in all, we'll wait for the agency to come for these two other plants.
So these aren't very material, even if they weren't.
They would not impact your business. They are not impacting the business in such a way commercially, but obviously we would like them to be inspected. And
yeah, so your 10 to 12% growth guidance and 19% margins aren't, predicated on the outcome of US FDA, results for these two facilities. Let's put it that way.
That's right. They're not impacting the business so much. Yeah.
Okay. All right, Mr. Mani, how about your balance sheet? How is that looking?
Balance sheet is looking quite okay. If you ask me, we ended the year with almost like a 1,000 crore addition to the reserves, and while our debt did go up by 1,200 crores, but that was mainly on the back of increased requirement for working capital, which was really down. Now we are pretty much very close to the peer where they have average days of 100 to 110 days. We'll be there close to that. So I think balance sheet looks quite okay.
What about ISB 2001? You did receive a fast track designation by the US FDA for multiple myeloma. Are there any out licensing talks going on here?
Yeah, we are in touch with a number of potential, interested parties, and we are hoping that we could have something come up and a positive outcome quite shortly. Yeah.
What's the roadmap for this asset?
Roadmap is obviously you would work on that, and then you'd work with the partner, and then you'll take it forward, and it looks good right now.
What we wanted to understand, sir, was what the financial roadmap.
The financial roadmap, we may not be in a position right now to give you, but all we can say is once this is done, after that, IGI would not obviously have to look at Glenmark for any funding or anything like that. And going forward, at least 3 to 4 years, the funding would be taken care by this. Yeah.
All right. Since the balance sheet is in much better shape, any inorganic growth plans?
Not at the moment, but obviously we continue to keep doing in-licensing deals. As you have heard, in India also we did this Beijing deal, and then we also had Winlevi, etc. So we continue to in-licensing transactions, but not looking at a M&A right away.
India was flat this time around, perhaps due to seasonality in respiratory, which did impact the portfolio, one would assume. What led to the weakness in the diabetes portfolio? How did key drugs such as liraglutide do?
So liraglutide continues to do quite okay. In a sense, we did have some supply issues there, but otherwise it's doing quite okay. It's the earlier products that we had of Remo and teneligliptin, those seem to have slightly degrown in this quarter, etc. So that's the reason why it is. But just to give you some color on the India business also, we had guided the street to about a 4,500 crore turnover in the current year, which we achieved. Obviously, the first half was much better than the second half, and as we already sort of guided that in this quarter we had some challenges with the acute respiratory as well as the diabetes portfolio, and I think let's see how things work out.
Final question, because everyone's been talking about this for the last couple of years, and this being the buzzword, and it goes off patent as well. Semaglutide. Are you eyeing this as an opportunity?
Yeah,
what plans do you have here?
Yes, we are also looking semaglutide as an opportunity, and obviously, we have already, I know we're already working with liraglutide. We'll obviously add semaglutide as well, and it will help us to probably,
How are you participating? I mean, have you spoken to some?
We are working with a couple of people, and we'll announce at the right time. Yeah.
By when?
It'll be a couple of weeks or months. Yeah.
Couple of weeks or months. We'll keep an eye out on that. Thank you so much for joining in and giving us all those details. I think, the street did not like what you had reported, but the commentary is something that the street is now coming to terms with, as a result of which, after opening a lot lower, the stock has seen a bit of a recovery, currently sitting with a cut of about 1.5%. At some point, did move into the green as well. That's Glenmark Pharma. But we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime. Now, this is a channel that will provide live and in-depth coverage of both global markets and economic developments through an India-first lens. On our inaugural episode of the Global Reset, we will be speaking with the chairman and CIO of GQG Partners, Rajiv Jain, today at 12 noon. Do tune into CNBC-TV18 Prime. You're watching us here on Chartbusters. As you can see at the top of the screen, market now indicates a fresh paint of green across the frontline indices, though mildly off highs, nothing really to worry about. And if you're looking at your portfolios, incredibly strong, because a lot of stocks which opened well are seeing a lot more gains, and a lot of stocks which opened flattish are piling onto those gains as well. There are a bunch of names. We could take that, but we're running out of time. So what we'll do is leave it to the team of Trading Hour, which comes up next.